Hey everyone, it's John with Rain King LLC. It's time for a general market update. It's March 24th, 2023. Again, a reminder, I'm an amateur individual growth stock investor, not affiliated with IBD, Market Smith. So before we launch in, I just wanted to wish Bill O'Neill, tomorrow is Bill's 90th birthday. So I think we all owe a great deal of gratitude to the teachings of Bill O'Neill and how he's educated the retail investor community like no other. So happy birthday, Bill. 90 wonderful years. So the agenda for the market update is we're going to go over the context and sentiment, some market internals. We'll look quickly at the Nasdaq and the S&P, and then we'll try to summarize it all in a few announcements. So context and sentiment. This is a chart from Carson Investment Research, basically looking at the last 20 years, the month of March. And March typically comes in kind of choppy on a downside bias, but typically the second half of the month is more positive. We're at the 24th, so that would be right about here, and we've had a very choppy early March. So it looks like the bias in the last 20 years is up. So that's encouraging. Now, to put this in a little bit more context, remember, back in January, we had the January trifecta, which basically improved the odds that it was going to be a pretty good year by the time we get way over here to December 31st. So we had a very strong January, very similar to this. And when you do have a very strong start in a particular year, this chart will show you historically since 1950, there's kind of a digestion period of February, March into April. So if this were to play out, in this fashion, it looks like there's good, brighter skies ahead for us for the second half of the year. We'll have to see how it plays out, but I thought it was an interesting piece from Carson Investment Research. Now, a little bit on the sentiment side. This is the AAII Investors Survey, individual retail investors. And you can see that they've increased their bearishness more than it was last week and much more than what it was 2 weeks ago. The bullish side is actually shrunken down to 20.9%, which is very low. You can see the historical averages are 37.5 for the bulls. So sentiment, certainly at the retail level, is very, very bearish. Now, on the right side, this is the National Association of Active Investment Managers. This is their exposure index, how much exposure they have to the market. In 2023, we saw some really good funds going into equities and other instruments, but it's come off sharply. And with the banking crisis, a large amount of money, and I can't remember the exact amount, but I believe it was over $200 to $250 billion has been moved in the past 2 weeks into money markets. So there's a flight to safety in some cases and out of other instruments in the market. So that could be perceived as a negative. At the same time, that money, when it comes back into the market, when things turn, could be fuel and buying power for institutions going forward. So a few market internals. Not a lot has changed since last week when we spoke. This is the New York Stock Exchange, the advanced decline line on the left, and the net new highs, new lows on the right. You can see the breadth has still been very, very poor since early February. Due to the financial sector's weakness, it's gotten hit pretty hard. A very quick reversal from where we were back in late January. So the breadth has not been good. You'll also see the net new lows has not changed much this past week. We're still getting expanding new lows, which is not what we want to see. And in general, you can just see the height of these bars is more than we've seen since the October lows. So it's not a good picture right there on the breadth of the market. If you take the XLK, which is the Technology Spider Index ETF, and you divide it by the SPY, which is the ETF for the S&P 500, you can see that technology is screamingly showing outperformance, very, very strong relative to the S&P ETF. So we're seeing strength in technologies relatively. Now, we know that, and we've talked about it, is the Nasdaq 100 is showing a lot of strength. The big mega cap seems to be a flight to safety. They're flush with cash. But when you look under the surface and you take the QQQE, which is the equal weight Nasdaq 100, not market weighted, you can see that the QQE is severely underperforming relative to the Qs. So under the surface, things are not nearly as strong as you're seeing in the Qs, which are dominated by Apple and Meta and Microsoft. So it's a different picture under the surface, very, very different. Now, this is showing the Qs once more. You can see the Qs in black have been very strong the last couple of weeks. But when you get under the surface and you look at the MDY, which is the mid-cap ETF, and the IWO, which are small caps, you can see some serious deterioration since middle of February. Very sharp deterioration. The Russell has got a number of financials in it. And you'll also notice that the MDY, if you go across here and look, it's making new lows for 2023. So that's not a good picture at all. And the IWO is approaching new lows for 2023. So those are not good, even though the Qs are supporting the index looking okay. It's not the full picture. So let's briefly look at the Nasdaq and the S&P 500. Now, this is the Nasdaq weekly chart. Now, as bad as the news has been, and as bad as the reaction was to some of the Fed talk on Tuesday, the index somehow has managed to stay above the 10-week moving average and the 40-week moving average. So that's a positive. You can see last week we had a lot of high volume support for the market, and we really needed it at that time to get us back up here. So that was a positive. And you'll notice that this week, which was not a great week in the market, the volume declined. So at a weekly viewpoint, a bird's eye view, the index is still fighting to stay above some support levels. So it doesn't mean we can't come back and retest, but we're certainly in a battleground right here. I've shown this a few times, but it's kind of the precedent that I'm using. It's the 1962 bottom versus the bottom that's forming here. Now, I'm using the S&P here, and I won't go through this in great detail because I have in other videos, but the concept is that once the market bottomed in 62, there was a retest, and that retest was really a big shake of the retest of the lows in October. And it was the Cuban Missile Crisis was the event that had everybody's attention, created a lot of uncertainty. Eventually, the crisis was resolved and the market moved higher. So if in a comparison way, we had a test of the October lows. Now with this banking crisis, there's still a lot of uncertainty. We don't know what's going to happen for sure. Is it possible we come back and test we've tested the December lows in the S&P. We have not done that yet in the Nasdaq. I know a lot of people feel that the market has not had a climax selling, but I have shown before that if you look at the 62 market, the real climax of selling came in leg number 2 down, where they had washout selling, and the index was down over 25%. In a similar way, leg 2 of this bear market was really what I consider the washout selling, where the market was off 24.5%, but growth stocks really, really washed down. And on the S&P, the weekly new lows that week were 50% of all the issues trading. So I think this week here, we actually did get climactic selling, and the retest happened here where we had the undercut in October, and then we've kind of rallied back above the 200-day moving average, and we're chopping along. So summary thoughts of where we are. When we last talked last Friday, we said the Fed meeting was coming up and it was important to watch the reaction. Well, the reaction was poor. Powell did not see any rate cuts in 2023, but the market clearly was seeing, and probably you could make a case saying the market still sees rate cuts. And Yellen did not reinforce the idea that the government would backstop bank deposits. So that combination led to a very violent reaction in reaction to the Fed meeting. Now, the banking crisis is still an overhang on the market. It's continuing to breed uncertainty. It's literally day to day. One day you hear things that it's under control. The next thing you hear that there's another bank that's showing some wavering signs. Now, the news, if you follow the news at all, it has been downright awful across the board. And that's typically the case near market bottoms. So it's not, don't let the news influence your view of the market. Now, despite all of that bad reaction, I think the positive side of the coin is the markets have not fallen apart. We have not sold down to the lows or broken to new lows yet. We're still holding in there. So we could go sideways in a trading range for a while as this banking issue gets resolved. And we'll have to see what happens in May at the next Fed meeting. But the bottom line here is there is no strong trend in the market currently. And study after study have shown that market trend accounts for 3/4 of a stock's movement. So we don't have strong trend, so that's working against us. Now, it's very important that you manage your risk and your exposure levels to the market. Now, this is something that you do control. So, if you're going to put your toe in the water, be very, very careful and on your positions, manage your stops, manage your risk and your overall exposure. When you tally up all of your stops, if they were hit, how much would that hit your account value? So we continue to stay engaged. We always want to observe and pay attention to what's happening. But that doesn't mean that we have to get in there and take positions until we think the odds have really shifted to make the risk reward in our favor. So pay attention to what's going on in the market, observe what's happening. We want to see the breadth improve. We have not seen that yet. We need to see the new high, new lows start to shrink up and become net new highs. And we don't have a follow through day yet either. So there's things we need to keep watching. But I would say always keep a fresh watch list. Know what you will buy if we do get a follow through or the market starts to move. There are growth stocks that charts are looking better. There's some growth stocks that are extended, but there are others that are still in bases that are taking time to form those bases. So we want to have that watch list really fresh. We want to have it ready to go so we don't freeze up when the time is right to take a position. So the quote is, the past year has been like taking a PhD course in risk management, both on the upside and the downside, whether bullish or bearish. It has been a very, very difficult bear market. Even the seasoned professionals have had a very difficult time being on the right side of the market and getting positioned properly. So if you're a retail investor and you're struggling and you're getting down on yourselves, put it in context. It's a very, very difficult environment, and even the pros are struggling, and it may be a time to just sit aside and wait for the conditions to improve. So just wanted to remind everybody that the earnings reaction gap workshop that I'm putting on with Jason Thompson of Ticker Monkey, there's still time if you're interested in that workshop. We've had a great response. Registration is still open. The tickermonkey.com website, go to the ERX Gap Workshop. There's a 7-minute video there that I will share with you the details of the workshop. It includes all of the things on the screen and more. We're having our VIP portion of the workshop this Sunday, and then our other workshop will be happening on April 15th. So there's 2 ways to participate. If you'd like, check out at least the 7-minute video to get exposed to what it's all about. And tomorrow I will be speaking at Mollyverse. I'll be talking to this West Coast group at 1 p.m. Eastern time, 10 p.m. Pacific. And the topic will be going to have some fun with this. I'm doing a model book stock simulation using Shopify. And we're going to cover Shopify from 2016 to 2021. We'll talk about the basing process, the run-ups, the topping process, and using some pretty straightforward portfolio management rules will show you how you could have taken advantage and added gains to your portfolio. So I'm looking forward to that tomorrow. In addition to the talk, after that, I will be taking a bunch of questions. Some people have submitted questions, and I've got some interesting slides to share relative to answering those questions. So I'm looking forward to it. That's all the time we have for now. This is the general market update for March 24th, 2023. If you're interested in the workshop, just go to my Twitter handle, RainKing at jpoco722, and it's pinned to my page, all the details there and the link. So hope to see you at the next general market update. Thanks everybody for joining me.